How much do you really need to invest to become a millionaire? Look around for a second. Everywhere you go, people throw around the same retirement number. $1 million. That's the magic target. The number people believe finally means freedom. No more alarms, no more asking for vacation days, no more checking your bank account before buying groceries. Just $1 million invested and working for you. But here's the question almost nobody asks. How much money do you actually need to invest to reach $1 million starting from zero? Not someday, not theoretically. I mean real numbers, real timelines, real sacrifice. Because the answer changes depending on one thing: time. And once you understand how time changes the math, you start looking at every financial decision differently. In this video, we're going to follow 3 completely different people. All 3 start with nothing. All 3 want the exact same goal: $1 million invested. But each person gives themselves a different timeline. One person gives themselves 30 years. One gives themselves 20. And one tries to pull it off in just 10 years. Same destination, completely different price. And by the end of this video, you're going to understand why time is the single most valuable asset in investing. My name is Alex, and on this channel, we break down money, investing, and long-term wealth building in a way that actually makes sense. So if that sounds useful, hit subscribe and let's get into it. Why does everyone obsess over $1 million? First, let's talk about why this number matters so much. Because honestly, $1 million used to sound impossible. Now it feels like the bare minimum. But there's a reason the number keeps showing up in retirement conversations. It comes from something called the 4% rule. The idea is simple. If you have a portfolio worth $1 million invested in diversified index funds, you can withdraw roughly 4% per year without running out of money too quickly. 4% of $1 million is $40,000 per year. That breaks down to about $3,333 every single month. And here's the important part. That money keeps coming whether you go to work or not. Your investments are producing the income. Now add Social Security on top of that. The average monthly Social Security benefit is roughly another $2,000 to $2,500 depending on your work history. Suddenly, your retirement income could be somewhere around $5,000 to $6,000 per month. Not billionaire money, but enough for a lot of people to live comfortably without needing a paycheck. So the question becomes, how do you actually get to $1 million? And the answer depends entirely on how much time you give the market to work. The 3 investment styles. For this example, we're using 3 different types of index-style investments. Not individual stock picking, not crypto speculation, not meme stocks, just long-term investing. Investment 1, the Broad Market Fund. This is the foundation. It tracks the biggest companies in America. Think Apple, Microsoft, Amazon, Google, Costco, Visa. Basically, when the overall economy grows, this fund grows too. Historically, broad market index funds have averaged around 10% annually over very long periods. Not every year, obviously. Some years are terrible. Some are incredible. But over decades, the average has been strong. This is the slow and steady part of the portfolio. Investment 2, growth stocks. Now we get more aggressive. These funds lean heavily into technology and fast-growing companies. Higher potential returns. Higher volatility, too. These types of investments historically outperform the broader market during strong growth periods. But when markets crash, they usually fall harder. This is where growth starts accelerating. Historically, broad market index funds have averaged around 10% annually over very long periods. Not every year, obviously. Some years are terrible, some are incredible. But over decades, the average has been strong. This is the slow and steady part of the portfolio. Investment 3, High risk, high growth sectors. This is the aggressive piece. Things like semiconductor companies, AI infrastructure, advanced tech, the companies powering modern technology. These investments can absolutely explode upward during growth cycles, but they can also get crushed during downturns. That's why the allocation matters. The less time you have, the more aggressively you're forced to invest, and that changes everything. Historically, broad market index funds have averaged around 10% annually over very long periods. Not every year, obviously. Some years are terrible. Some are incredible. But over decades, the average has been strong. This is the slow and steady part of the portfolio. Scenario 1, the 30-year plan. Let's start with the easiest version. 30 years. This person is patient. Maybe they're in their 20s or early 30s. They understand they don't need to rush. And because they have time, they don't need to take insane risks. Their portfolio looks something like this: 60% broad market index funds, 30% growth-focused funds, 10% aggressive high-growth sectors. Mostly stable, a little aggressive, long-term focused. Now here's the crazy part. To reach $1 million in 30 years, they only need to invest about $6 per day. That's it. $6. About the cost of coffee and breakfast. Around $180 per month. And over time, this is what happens. At first, almost nothing changes. Year 1, the account barely moves. Year 5, still feels small. Year 10, now the balance starts becoming noticeable. Then something strange happens. The growth begins accelerating because compound interest is no longer growing on just your contributions. Now it's growing on Scenario 2, the 20-year plan. Now let's cut the timeline down. 20 years instead of 30. This changes the math dramatically because when you remove 10 years of compounding, the investor has to compensate with larger contributions. The portfolio also becomes more aggressive. Now it looks something like this: 35% broad market, 40% growth funds, 25% aggressive sectors. Less stability, more growth focus. Because now, speed matters. To reach $1 million in 20 years, the investor now needs roughly $22 per day. That's around $660 per month, almost 4 times more than the 30-year plan. And this is where investing starts becoming psychological. Because $6 per day feels easy to ignore. $22 per day feels real. Now you're making trade-offs. Maybe fewer restaurant meals. Maybe a smaller car payment. Maybe cutting unnecessary subscriptions. Now, wealth building requires actual intentionality. But the payoff is massive. By year 20, the portfolio still reaches the same $1 million finish line. But notice what changed. This investor contributed over $160,000 personally. The market still helped enormously. But compared to the 30-year version, the investor had to fund far more of the outcome themselves. Why? Because they gave compounding less time to work. This is the invisible cost of waiting. Every year you delay investing, future you has to contribute more money to make up for lost time. Scenario 3, the 10-year plan. Now we get to the version everybody clicks for. The fast version. The I want financial freedom quickly version. And this is where the math becomes brutal. Because turning 0 into $1 million in just 10 years requires extreme effort. The portfolio becomes heavily aggressive. Something like 15% broad market, 35% growth funds, 50% high growth sectors. Half the portfolio is now concentrated in aggressive investments. Because broad market growth alone usually isn't enough over just 1 decade. Now here's the number. To reach $1 million in 10 years, you need to invest about $120 per day. Every single day. That's roughly $3,650 per month, $43,800 per year for 10 straight years. And suddenly, the entire conversation changes. Because now this isn't about casually investing spare change. Now income matters. Career matters. Business ownership matters. High earning power matters. This plan realistically requires a very strong income. But if someone can do it, the results are incredible. By year 10, the account crosses $1 million. But here's the key difference. The investor personally contributed nearly $500,000. The market still helped, but compounding barely had enough time to dominate. The investor did almost as much work as the investments themselves. That's the price of compressing time.
The real lesson nobody talks about. Here's what's fascinating. All three investors reached the exact same destination, $1 million. But the path changed completely. The 30-year investor used patience. The 20-year investor used discipline. The 10-year investor used income and aggression. Same result, different sacrifices. And this reveals something most people never fully understand. Time is the cheapest investment you can make. The longer you give compounding to work, the less money you personally need to contribute. The shorter the timeline, the more you must replace time with your own income. That's the trade. You either contribute money or you contribute years.
Why most people struggle with investing. And honestly, this is where many people fail. Not because investing is complicated, but because consistency is psychologically difficult. At first, investing feels pointless. You contribute $200. The account moves to $205. Big deal. Then markets crash. Your account drops. You panic. You think investing doesn't work. But the truth is, the first decade of investing is usually boring. The life-changing growth happens later. Most people quit before compounding has enough time to become visible. That's why patience matters more than brilliance. The most important chart in investing. Imagine two people. Person A starts investing at 25. Person B waits until 35. Both invest the same amount monthly. By retirement age, person A often ends up with dramatically more money you'll ever invest. Not because they're larger, because they get the most time to compound. That's why starting matters so much more than perfection.
So, which timeline is best? Honestly, the best timeline is the one you can actually stick to. Some people genuinely can invest aggressively and fast-track wealth building. Others need a slower, steadier approach. Both are fine. The danger is pretending you'll follow a plan that doesn't realistically fit your life. Because sustainable investing beats extreme investing that collapses after 6 months. Always. Final thoughts. So let's simplify everything we covered. If you want $1 million, 30 years requires surprisingly small daily investing. 20 years requires real discipline. 10 years requires major income and aggressive investing. But the biggest takeaway is this. Compounding rewards time more than talent. The earlier you start, the less painful the process becomes. And the longer you wait, the more expensive the exact same goal becomes. That's the real math. Not motivation, not hustle quotes, not lottery ticket investing. Just time, consistency, and compound growth. If this video helped you understand how investing timelines actually work, hit the like button and subscribe. And I'm curious, which version feels most realistic to you right now? The 30-year plan? The 20-year plan? Or are you trying to sprint toward financial freedom in 10? Drop it in the comments. And remember, the best time to start investing was years ago. The second best time is today.